What's up everybody, Gen X Dividend Investor here. In this video I'll dive into whether super high yield dividend ETFs, which have been gaining in popularity for a while, are actually safe enough to invest into. I'll also teach you some concepts that are important to understand when investing in high yield ETFs, so I recommend you watch this from start to end. So high yielding dividend ETFs started gaining popularity in the mid to late 2000s, particularly after the 2008 financial crisis. During this period, investors were looking for safer, income-generating investments due to the volatility in the broader stock market and due to historically low interest rates that made traditional fixed income investments, like bonds, less attractive. Plus, the shift towards passive investing and ETFs, which can offer diversification and lower fees, made dividend-focused ETFs even more compelling. But I don't remember high yield back then being quite as crazy as it is today. Like in 2010, Vanguard had a fund called the High Dividend Yield Index Fund, ticker VYM, which still exists, and it was trading for around $35 a share back then. Checking out Seeking Alpha, we see that in 2010, VYM paid out $1.09 in divvies for the year. That means its yield was only at 3.1%, so not exactly high in today's terms. But that was high when you looked at the dividend yield of the SP 500. In 2010, the SP 500's dividend yield was only at 1.8%, and it usually stayed under 2%, so Vanguard's high-yield ETF being over 50% higher was good back then, especially when you looked at interest rates. I mean, in 2010, interest rates were almost at 0%, specifically being at 0.18%. So putting your money in a savings account or CDs wasn't going to cut it either. Plus, CDs and bank interest don't tend to grow like ETFs can. For example, here are VYM's total returns from 2010 until now. It's at 443%, which blows out cash returns over time, but that still doesn't match the SP 500, which had returned 601%. And as time went on, with the 2008 financial crisis in our rearview mirrors, people's appetite for risk started increasing. Super high-yielding ETFs were popping up. For example, Global X's Super Dividend ETF, SDIV, was born in 2011. It holds a bunch of high-yielding tickers from companies around the world. Right now, it's got a decently high expense ratio at 0.58%, along with a super high yield of around 11%. Now, that could seem pretty compelling for people who hyperfixate on yield over anything else, and it pays monthly, which is something else people tend to like. But this SDIV stock price chart over time tells you part of the story of what often happens with super high yield tickers. Not always, mind you, just frequently. You can see how it trended down from almost 80-ish bucks when it started down to 21 bucks today. But let's check out total returns to see if its huge dividend yield saved it. Unfortunately, it looks like it had a negative total return since inception, even with its crazy high yields. Specifically, it returned minus 10% total as compared to the 484% for the SP 500 over the same time frame. SDIV's long-term decline is likely due to its focus on high-yield, lower-quality stocks that often underperform, struggle to sustain dividends, and suffer during rising interest rates. In my experience, when I see yields over 8%, it often means higher risk assets like junk bonds or maybe risky mortgage-backed securities or maybe lots of leverage is being used or something. High yields often mean greater volatility and risk. Another class of high-income ETFs are option-based ones like covered call ETFs. These sorts of ETFs often generate income from the underlying tickers they hold, which often means dividends and option premiums. But you can find covered call tickers that will manage to outperform, at least for periods of time. Thus, an important takeaway is that you really need to dive into the details of your ETFs to understand how they work, what they hold, what the risks are, the expenses, etc. Like, is your ETF holding riskier assets like below investment grade securities? Do you know how the income you'll be getting will be taxed? How long has the ticker been around for and how has it historically performed? Who's managing the ETF and how reputable are they? And then of course, should you be focused on high yield ETFs or should you be focused on total returns or what makes sense given your realities? I generally think it's a bad idea for young investors to focus on super high yield income ETFs because odds are you do a lot better over the long term if you just focus on the SP 500. But there could be good reasons for you to get income now, especially if you're new or in retirement. It all depends on you. Anyway, let's take a look at a well-known high-yield covered call dividend ETF in QYLD, and it came into inception in late 2013. It focuses on a covered call strategy on the NASDAQ 100, attempting to generate income from option premiums, which often means limited upside in bull markets. It's a monthly payer and has a super high trailing 12-month distribution yield of 12.6%. Let's take a look at its stock price since inception. Here we see that it opened at 25 bucks a share, but it's trended down over the last decade to around 18-ish bucks right now. However, we know that total returns are what often matters the most, so let's see what Seeking Alpha says. Here we see that it had 146% total return as compared to 309% for the SP 500 over the same time frame. So I'd say that at first glance, QYLD is an income-focused ETF designed for investors seeking high payouts rather than capital appreciation. It's probably better for cash flow focused portfolios, but it's not ideal for long-term growth investors. And is it safe? Well, both high yield and safe are subjective words. To me, safety should encompass sustainability, at least to some degree, which again is a subjective word, but it does capture a key part of what I'm trying to get across. And to see a continually declining stock price probably means it isn't very sustainable. Now, they could do a reverse split to push its stock price back up, but that has its own issues. You're probably used to companies like Apple or Microsoft doing a split to make their shares cheaper since their stock has trended up so much over time, and the opposite can happen as well, which is what a reverse split does. It's important to understand that a reverse split doesn't change the fundamental value of your holdings, but it does often signal underlying problems that can affect investor sentiment. What I mean is that a reverse split often signals to the market that the ticker in question is struggling. It can be seen as something managers are doing to band-aid over poor performance rather than address the underlying issue which is causing the price drop in the first place. Like maybe the amount they are distributing is depleting net asset value or NAV over time, and in a moment I'll explain what NAV is and why declining NAV often leads to problems. Plus, when you do a reverse split, there are less shares on the market, which usually means lower trading volumes, meaning it's less liquid. And there are some investors who hyperfixate on price, and a higher price post-split may deter less informed investors who aren't sure what's going on. A reverse split might mean higher volatility, because with fewer shares outstanding, then we probably will see more price swings, especially in less liquid markets. Of course, that can be better for option premium strategies. Some companies and funds do reverse splits in order to avoid delisting if their price gets too low, so even though it doesn't affect intrinsic value, many investors view reverse splits negatively, which can lead to further sell-offs. Another thing to be aware of is that reverse splits can complicate tax reporting, especially for long-term holders who need to adjust their cost basis, which can be a nuisance for some investors during tax season. When I see things reverse split, I often think it's more of a symptom than a solution. It often doesn't address the core issue of declining price performance, which may stem from the ETF strategy limitations, payout structure, or market conditions. And while the share price might look healthier post-split, the risk of continued declines, distribution cuts, or reduced investor confidence remain if underlying issues aren't fixed. Okay, so now let's talk about net asset value. A fund's NAV is the sum of all its assets, which means the value of its holdings, its cash, shares, bonds, etc., minus any liabilities, all divided by the number of shares outstanding. NAV is basically an indication of the fair value of a single share of the fund, and if a stock price is higher than the NAV, called trading at a premium, then it might seem expensive, but this usually doesn't last long because traders will step in to balance it out. If the stock price is lower than the NAV, aka trading at a discount, then it might seem cheap, but again, market forces usually correct this quickly. If the NAV of an ETF is declining and its stock price is dropping, then oftentimes that will lead to a cut in payouts. But there are always counterexamples that don't follow the norms. Like when the pandemic first hit us, we saw how many bond ETFs were under financial stress, and those ETFs were trading at significant discounts to their NAV, even though the actual bonds they held hadn't necessarily declined as much in value. And it's important to remember that market fluctuations are normal, and a declining ETF may rebound over time depending on the underlying assets and market conditions. Anyway, as NAV drops, the dividend yield percentage might stay high because it's calculated on a shrinking base, and this can create a dividend trap. Basically, it looks like you're getting great income due to the high yield, but the underlying value of your investment is actually deteriorating. If a covered call ETF's NAV keeps declining, it can have some pretty big implications, both for the fund's performance and for you as an investor. That's because a declining NAV tends to mean a smaller portfolio. If it keeps dropping, the fund ends up holding fewer or lower valued assets. This means fewer shares to write options on, which can lead to lower premium income over time. When the NAV, and thus the price of the underlying asset, declines, the call options are written at lower strike prices, which also typically reduces the premium income the fund can generate. And if the NAV drops too much, you'll probably see distributions get cut since they won't be able to generate enough premium. Or to put it another way, if the market crashes, I wouldn't be surprised if some covered call ETFs see materially lower payouts. And while a market crash often causes a short-term spike in volatility, which could temporarily increase option premiums, sustained downturns usually lead to reduced market activity and volatility over time. And then lower volatility results in cheaper option premiums, reducing the income those ETFs probably will generate. Covered call ETFs also often rely on dividends from the stocks they hold as part of their payout strategy. So during a market crash, companies are more likely to cut or suspend dividends to preserve cash, further reducing the ETF's income, especially if that ETF is going with riskier underlying dividend tickers. Now, covered calls can provide some downside protection through premiums collected. However, the protection is limited. The premium income probably only offsets a small portion of losses. If the broader market declines sharply, or the ETF holds volatile stocks, its NAV can decline faster than expected, and the premiums probably won't be enough to cushion the blow. And if the NAV keeps dropping, then an ETF might be returning more capital than it's earning, effectively giving you your own money back to you while the portfolio value shrinks. Over time, this erodes your investment and leads us to the next important concept to understand, which is return of capital, or ROC. ROC often reduces your cost basis in an investment. That means when you eventually sell your shares, you'll owe more in capital gains taxes because your adjusted cost basis will be lower. For example, let's say you buy ETF shares for $1,000, so your cost basis is $1,000. Then let's say you get $100 return of capital dividend distribution payout. Your new cost basis would then be $900. When you sell, your gains are calculated relative to the $900 instead of the original $1,000. Thus, you want to track your ROC adjustments so you aren't surprised by a bigger tax bill when you sell, since the capital gain can appear larger than you might expect. And some funds distribute more cash than their taxable income, especially in sectors like energy or infrastructure. And again, in some cases, if the fund is struggling to generate income, it could basically be giving you back a portion of your investment to maintain its distribution. That becomes more concerning because it could signal unsustainable payouts. Like imagine you started a super high yield dividend ETF and you said you intend to pay out a 10% yield. You decide to use strategies like options trading and collecting dividends to generate that income, and you advertise that you can maintain that high yield. But let's say your options trades don't perform as expected for a while, and you know that your investors will be upset if you pay out less than the 10% they expect. So to keep up appearances, you decide to return part of your investors' principal, their original investment, to cover the gap between the 10% yield they expect and the actual income you generated from options and dividends. Essentially, you're just giving back the money investors initially gave you, disguising it as part of their yield. This can work temporarily, as long as you have enough cash and as long as new investors keep buying into your ETF faster than you're paying out distributions or facing redemptions. And that kind of sounds like a Ponzi scheme when you think about it, but it's not. I mean, Ponzi's are illegal. Anyway, with that basic understanding of ROC, let's get back to QYLD again, because some covered call ETFs maintain high distributions by paying return of capital when their income isn't enough. You can often check out an ETF's website to see how they're taxed and if they're paying out qualified dividends or ordinary income or capital gains or ROC or whatever. For example, here's one of the tax documents listed for QYLD, and it shows that almost all of its current distribution was return of capital. Now when we talk about ROC, there's good ROC and there's destructive or bad ROC. A key difference comes down to how the return of capital is generated and its impact on the fund's net asset value. Bad ROC happens when a fund can't generate enough income from its dividends, interest, or capital gains, so it returns part of your original investment to maintain distributions. This can deplete its capital base, leading to a declining NAV over time. So if an ETF isn't earning enough but still pays a high distribution by dipping into principal, it's effectively reducing the value of its holdings, which is probably a bad sign. A good example of ROC might be due to tax efficiency. Like in some covered call ETFs, the cash flow from option premiums is classified as ROC for tax purposes. If the ETF is earning enough through its covered call strategy and dividends, but the distributions are labeled as ROC due to accounting rules, it shouldn't be harmful. And in fact, it can defer your tax liability until you sell the shares because ROC reduces your cost basis rather than being taxed as immediate income, like I said. So check out the fund's NAV over time. If NAV is stable or growing while distributing ROC, it's likely good ROC. If NAV is consistently declining, it could be destructive ROC. Websites like Morningstar will sometimes show you NAV over time. Now, a declining NAV in a covered call ETF isn't automatically terrible, but it can signal deeper issues like unsustainable distributions, poor stock performance, or an over-reliance on ROC. If the NAV keeps falling without signs of a recovery, you could end up with high yields but shrinking capital, turning what seemed like an income-generating asset into a losing investment. I thought it would be interesting to map the last decade or so of QYLD's approximate stock price and annual dividend paid out per share, along with the SP 500's price, to see what I found. Well, from 2014 to 2024, QYLD's stock price fell 27% and its dividend payout fell around 12%, whereas the SP 500 went up 227%. It would be interesting if we had been in a bear market for years to see how QYLD would have done, but regardless, this is poor performance, especially given the market conditions, especially if you're getting taxed. And let's talk about taxes for a second, since that can act as a big drag on your investments. If you're investing in retirement accounts and you aren't taking withdrawals, then you usually don't need to worry about taxes too much, but in taxable accounts you gotta be aware. Most high-yield ETFs pay out as ordinary income, kinda like job income, which is often some of the worst tax implications. They also sometimes pay out as return of capital or capital gains, more interest income or foreign tax credits, or etc. Ordinary income is typically taxed at your marginal tax rate, which increases as your income moves into higher tax brackets. In the US, for example, the federal income tax has progressive brackets ranging from 10% to 37%. On top of that, state and local income taxes may apply, depending on where you live. Ordinary income is often taxed at higher rates than long-term capital gains or qualified dividends, which benefit from preferential tax rates, which typically are 0%, 15%, or 20% depending on your income. So be careful not to only look at the dividend yield of an investment without factoring in other things like expenses and taxes and all that stuff. In some cases, a lower yield from qualified dividends could be more take-home money than a higher yield of ordinary income in a taxable account. Thus, understanding how different types of income are taxed can help you plan to minimize your tax liability, especially by leveraging tax advantage accounts or just adjusting your investment strategies. Moving beyond covered call ETFs, another type of high-yield investment to be aware of is closed-end funds or CEFs. CEFs are often considered riskier than traditional ETFs because many use leverage, which can amplify gains but also magnify losses, increasing risk, especially in downturns. They also tend to have lower liquidity due to their fixed number of shares, which can cause additional volatility and other potential concerns. Many CEFs offer attractive yields, but these distributions might come from destructive return of capital rather than actual investment income, potentially eroding NAV over time. There are also ETFs that hold baskets of closed-end funds, like Amplify's High Income ETF, ticker YYY, which focuses on providing high income by holding CEFs that invest in high-yield bonds, leveraged loans, and other income-producing assets. The yield can be attractive, but there are several risks to consider. Like one risk is interest rates. As interest rates rise, the value of income-generating assets like bonds typically falls. YYY's focus on high-yield and fixed-income securities likely makes it sensitive to changes in interest rates. It also carries credit risk since it holds a basket of closed-end funds, some of which invest in high-yield junk bonds, leveraged loans, preferred stocks, and other income-producing assets. And leverage always has its risks. It also might have liquidity risks. Closed-end funds are often less liquid than traditional ETFs, which can make it harder to sell shares at a desirable price, especially in volatile markets. It also has distribution risk. The fund's high distributions might always be sustainable, particularly if the underlying CEFs underperform or cut their dividends. It also has a super high expense ratio of 3.25%. That's quite a management fee, which impacts returns over time. But hey, it's yielding over 12%, so dig into all its details to see what you think. Another example of a super high-yield CEF is PIMCO's Dynamic Income Fund, ticker PDI, with yields often between 10 to 12%. PDI focuses on income-generating fixed-income securities, including mortgage-backed securities, high-yield bonds, and emerging market debt. It uses leverage to amplify returns. I think holding a small portion of your investable assets in good CEFs can make sense for certain types of experienced investors who understand what they are and what they aren't. Everything you invest in has risks, so you need to judge if it's safe for your needs. High-yield dividend ETFs have become popular as a way to capture income, but whether they are safe depends on your investment objectives, risk tolerance, and the specific ETF structure. Another higher-yielding ETF type, though usually not into the super high-yield category, are real estate investment trust REITs. Those are probably more in the 3 to 7% range, so decently high, but not going into the crazy double-digit percentage levels. High-yield bonds can also fall into the super high-income category, as some are in the 5 to 10% range, and again, the higher it goes, the more you gotta be careful. Master limited partnership ETFs are also often higher yield, and they're usually tied heavily into the energy sector, which can be volatile. MLPs have complex tax structures, which can bring its own issues to be aware of. Single ticker MLPs like Enterprise Products Partners, ticker EPD, issue K1s, whereas MLP ETFs typically issue 1099 div forms instead, which are simpler for tax reporting, which is one key reason why some investors prefer MLP ETFs over directly investing in MLPs. I actually own EPD and I just pass its K1 every year to my tax person, so I've not had to deal with it myself. And note, I really love my EPD position, along with its ROC. And on Friday the 14th of February, which is 2 days from the time I'm doing this section of the video, I should get a distribution from EPD for $2,559, all of which I'll owe $0 federal income taxes on, as it's simply lowering my cost basis in my taxable account. How cool is that? I estimate that I have over 5 years of those federal tax-free distributions from then until my cost basis hits $0, at which point I'll start owing taxes on its distributions. But even though I like it in my retirement, it's not something I'd recommend young people own who are trying to grow their net worth, at least generally speaking. Anyway, for MLPs, you want to check their financial health with metrics like distributable cash flow amongst others to ensure distributions are covered comfortably. An example of an MLP ETF is Illyrian, ticker AMLP. Another example would be Global X MLP ETF, ticker MLPA. Moving on, other high-yield dividend ETFs include some preferred stock ETFs, which often pay fixed dividends, like bonds, but are technically equity. These ETFs focus on preferred shares, offering higher yields than common stock dividends. Examples include iShares Preferred and Income Securities ETF, ticker PFF, and Invesco Preferred ETF, ticker PGX. Yields are often in the 5 to 7% range, and one risk to be aware of is interest rate risk, since preferreds act a lot like bonds, and they have potential for missing dividend payments if the issuer runs into trouble. Another higher yielding ETF can come from emerging market ETFs. These ETFs invest in high dividend paying companies from emerging markets where yields can be higher due to increased risk. Examples include iShares Emerging Markets Dividend ETF, ticker DVYE, and WisdomTree Emerging Markets High Dividend Fund, ticker DEM. You often can get 4 to 8% or more yields with them, and they'll have their own risks like currency fluctuations, political instability, and economic volatility in emerging markets, along with potentially less regulatory oversight. There are actually tons of different super high yield ETFs out there, and lots of new ones are being added all the time. Like one that I've heard of more recently is NEOS's S&P 500 High Income ETF, ticker SPYI, which aims to offer high monthly income in a more tax-efficient manner, with the potential for upside capture in rising markets. And unlike traditional covered call ETFs, SPYI does not write calls directly on the stocks it holds. Instead, it sells S&P 500 index options, aka SPX options, which have some potential advantages like they're cash settled, meaning there's no risk of having to deliver shares, unlike covered call ETFs that sell calls on individual stocks and risk having them called away. Plus, SPX options are apparently taxed as 6% long-term, 40% short-term capital gains, leading to potential tax benefits compared to standard covered calls, where gains are usually taxed as short-term income. So do any super high-yielding dividend ETFs ever outperform? Yes, though probably just for a period of time. For example, take a look at a popular high yielder aka Yieldmax's NVDY Option Income Strategy ETF, ticker NVDY. It boasts a crazy yield of over 50%. And in just a year and a few months, it has returned 191%, as compared to the SP 500, which has done about 51%. Now, is that more of an edge case? I think so. Of course, if you'd bought Nvidia stock itself before generative AI blew up, then you'd have a 365% comparative return when looking over the same time frame. So it shouldn't be too surprising that Yieldmax's ETF did so well. It generates monthly income by selling call options in order to generate its compelling yields. Interestingly, a significant portion of NVDY's assets are invested in US Treasury notes and bills. And instead of directing holding Nvidia stock, NVDY uses a synthetic covered call strategy, which involves holding cash in US Treasuries as collateral while selling call options on Nvidia. By selling these call options, the fund collects premiums, which contribute to its income. The US Treasury holdings probably also generate some interest income, though that's probably minimal. And employing strategies such as options overlays or other derivative techniques can all boost the yield, though everything has its own risks to be aware of. I'd bet we won't see that level of ongoing performance out of this Yieldmax ETF, but hey, anything's possible. I heard a different Yieldmax ETF that was focused on Tesla implemented a 1-for-2 reverse stock split, meaning each shareholder received 1 new share for every 2 shares previously held. Pretty wild stuff overall. I'm a pretty conservative guy, and I only have about 5% of my portfolio in a super high yield dividend ETF in JEPQ. It has its own risks, like everything does, including some kind of unique ones like its use of ELNs. So bottom line, are super high yield dividend ETFs safe? Well, that depends on your definitions of the words and your risk tolerance and the time frames for your expected results. Again, you've got to evaluate each potential investment and think about its payout sustainability, its quality of underlying holdings, its sector concentration risks, liquidity and trading concerns, expense ratios, how long it's been in existence and who the company's behind it, taxes, and all that other jazz I talked about. High-yield dividend ETFs can offer attractive income opportunities, but they come with trade-offs. The higher yields often come with higher risks. So read the ETF's prospectuses carefully, consider how the ETF fits into your overall portfolio strategy and risk tolerance, and of course don't knee-jerk buy into something just because someone mentioned it in a YouTube video. Assume what you hear is wrong, and double-check everything on your own that matters. And if you do jump into a super high yielder, then I recommend you limit the size of your position to just a few %. I definitely wouldn't go all in or anything remotely like that. And with that, I'll close things off and ask that you please do me a favor and hit that thumbs up button, subscribe if you haven't yet, and click the bell notification. And now I'd like to do a shout out to my latest Patreon aristocrat, Drew Stone. I'd also like to shout out my newest channel member, Silverman, who I've been recently chatting with in my video comments. And thanks to all my channel members listed here, starting with my longest members up top down to my most recent members on the bottom. Channel members get a variety of perks, such as the ability to watch my videos before I release them publicly, and they get to vote on which thumbnails I use, and they get a special badge icon by their comments, which levels up over time, amongst other things. I'm also an affiliate for 2 services which I personally use and have paid for since I value them so much. So consider using my FastGraphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment, even if they sign up for a full year. Also check out my Seeking Alpha affiliate link, as new users often get benefits for signing up. I also offer some cool perks you might want on my Patreon page. And whatever you do, don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 84 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.